Do you think everything is just taking its natural course? It's just the US fighting overseas, so how could the global stock market not crash? Once they finish fighting, it will naturally go back up, right? Everyone, let's think about this for a second. What if I told you that this stock market crash is exactly the same as 2008 when Lehman Brothers collapsed? Would you find that hard to accept? Because there would be no specific enemy to blame for it. But if I tell you that this stock market crash is because of a war, you might feel like it makes sense. Why? Because war is just a temporary panic. It's just a fleeting cloud. Endure it, and it will pass. In other words, does it mean that as long as a war is artificially created, a stock market crash can be rationalized? Does it mean humanity's pain threshold for a market crash can be reduced? Does it mean the truth of a financial crisis can be delayed and covered up? So are you sure your money is still there? Hello everyone, welcome to Stewardship Finance Academy. The real reason for the 2008 financial crisis wasn't just that Lehman collapsed. It was that everyone wanted to take their money out of the US, only to suddenly find that the US had closed its doors. And what about this time in 2026? What some people want us to accept is a stock market crash caused by global conflict. But did you know that before this war even happened, the wealthiest institutions on Wall Street had already started to collapse? For example, Blue Owl has already plummeted by 64%. Blackstone has plummeted by 43%. BlackRock has plummeted by 24%. Apollo dropped by 46%, and TPG plummeted by 43%. You might think, what does their plummet have to do with me? I didn't buy their company's stock anyway. But if you look at the world, whether it's the tech giants like Google, Facebook, Amazon, or Tesla, or any industry you can think of, like Shell and mobile and oil, Johnson & Johnson and Pfizer in pharmaceuticals, even Disney, Netflix, Louis Vuitton, and Zara, just any name you can call out, you will find the presence of these institutions among their major shareholders, especially BlackRock. The US Treasury is handed over to them to manage. US pensions are also handed over to them to manage. Even after the US took over Ukraine's economy, it was handed over to them to manage. In other words, they are the wealthiest institutions on Wall Street and the stabilizing force of the entire financial circle. But now they are having issues one after another. What kind of issues? It's exactly like 2008. Investors want to take out the money they put in, but they won't let them. For example, investors wanted to withdraw $1.2 billion from BlackRock, but it only gave them $600 million. At Blackstone, countless people frantically tried to withdraw money at the same time. It had no choice but to pay out of its own pocket, and even forced managers of 150 companies to raise funds just to pay this off. The most ruthless one is Blue Owl, which directly closed its withdrawal channels. Meaning, if you want to withdraw money, you don't even have a button to click. To put it simply, Wall Street giants in the US are already experiencing a bank run. So the question arises, why would a bank run happen at the exact same time? Why are your clients, my clients, and their clients all withdrawing money from us simultaneously? Also, these clients just want to get their own money back, so why not give it to them? It's very simple. If you have 10 trillion in cash on hand and your client asks you for 100 million, would you refuse? Of course not. Now you're holding 10 trillion, so why would you ruin your reputation over a mere 100 million? But what if you only have 100 million on hand? Or what if you don't even have 100 million? If you want to return the money to the clients, you would have to sell off all your assets and convert them to cash. Then the question comes, if the whole of Wall Street experiences a run and everyone has to sell their assets at the same time, what will happen? A panic crash. In other words, this proves three things. First, these Wall Street giants are already very short on cash. Second, there is a group of people urgently withdrawing capital at the same time. Why? Because a bubble never starts bursting from the most dazzling companies. During the dot-com bubble, the first to have issues were the financial institutions injecting blood into the internet. During the subprime mortgage crisis, the first to have issues were the financial institutions injecting blood into mortgages. Every time it's the ones supplying the blood that have issues first, and then when there's no blood left, it crashes. So what about this time? This group of Wall Street giants are the ones injecting blood into AI, and now they are actually experiencing a run. So can we reasonably infer that this crash is not just because of the war, but that a financial crisis has already surfaced? Today I am exposing this covered-up truth. For the past few years, people have been attacking the data we present, but it doesn't matter anymore. I just want to share what I know with the people who support Stewardship Finance Academy. If you are tired of the mainstream narrative and want to protect your wealth, you need to be prepared. Check out the SFA Free Stock Investment Masterclass using the link in the description below. We'll teach you how to read the real signals before the market crashes. First of all, BlackRock, Blackstone, Blue Owl, what exactly are these private equity funds? Why is it that their current issues and bank runs can be linked to a financial crisis just like in 2008? In 2006, the Federal Reserve cut interest rates to 1%, and it stayed that way for 2 years. That meant banks at the time were full of cash, but they were actually worrying about this money. because cash doesn't bring in any returns, so they had to lend all this money out. But all the good clients who could borrow money from banks had already borrowed as much as they could, so they could only lend to those who couldn't borrow money before. For example, to those with no proof of assets and very low income, banks chased after them saying, "House prices are rising right now. I'll lend you money to buy a house and you don't need a down payment. The first 2 years, you just pay me the interest. 2 years later, house prices double and you can sell it. By then, you will be a millionaire." This wasn't actually lending money, it was giving money away. Why did banks dare to do this? Because they never intended to hold on to these loans themselves. For example, a bank lends out $1 trillion to subprime borrowers and collects 6% interest every month. Then they package these 6% interest loans into a wealth management product. They find someone to slap a AAA rating on these garbage assets. Then they sell them to investment banks, giving them 4% interest every year. When the investment bank uses $1 trillion to buy these junk bonds, the original bank gets its $1 trillion back. The borrowers pay 6% interest. The bank pays the investment bank 4% interest, and the bank directly makes a 2% profit in the middle. The investment banks wouldn't possibly lend money directly to those high-risk borrowers, so the bank just acts as a middleman. Well, everyone knows the result. The borrowers couldn't repay the money. Those clients who gave their money to the investment banks ran to the investment banks wanting to withdraw their money. That's a bank run. The investment banks couldn't pay, so they had to sell off assets simultaneously, liquidating stocks, bonds, and houses. If they still couldn't pay, they could only go bankrupt. It's when all assets are simultaneously dumped, investment banks collapse, banks can't recover their money, and a liquidity crisis occurs. Everyone in the entire market has no money. And then came the financial crisis. So now, in 2026, it's the same script, just different actors. What does this mean? In 2008, such a massive disaster happened, yet the banks inexplicably held no responsibility. So in order to restore everyone's confidence, regulators set up stress tests, the Basel Accords, and reserve requirements. It stipulated that banks worldwide could no longer lend money out as casually as before. Banks indeed became safe. But what about those companies that couldn't borrow money, especially mid-sized companies with annual revenues of tens to hundreds of millions? Not big enough to issue bonds and not safe enough for banks to be willing to lend to them. So since banks aren't allowed to lend money, Wall Street created something called private equity funds, just like Blackstone, BlackRock, Blue Owl, and Apollo. We mentioned before that AI burns through cash very quickly. Building a single data center starts at tens of billions of dollars. GPUs need to be bought, power facilities need to be built, cooling systems need to be installed. Every single item is an astronomical figure. If tech giants like Meta were to pay out of their own pockets to do this, their financial reports would look terrible, because revenue would be far less than expenditure, resulting in year-over-year losses. So they find these private equity funds to borrow from, borrowing trillions of dollars every year and repaying it over 20 to 30 years. In other words, for this whole AI research and development boom, a quarter of the money is borrowed from private equity funds. Private equity funds are the ones supplying blood to AI. And then what? Private equity funds bundle these loans and sell them to insurance companies, pension funds, and somewhat wealthy retail investors. Just like the banks in 2008, acting as a middleman. The ones borrowing the money are tech giants that seemingly have great credit. And where does the money come from? It comes from people all over the world who took their money to buy insurance and pensions. This scale has reached $3.5 trillion, larger than the GDP of South Korea and Germany. Once this thing crashes, it can directly destroy an economy the size of South Korea or Germany. So the question arises. Tech giants borrowed so much money to buy GPUs, but their actual lifespan is 2 years at most. Once new cards hit the market, the prices of these old cards become worthless. You have $1 million in insurance. The insurance company gave your $1 million to a private equity fund. The private equity fund lent it to an AI company to buy a GPU that becomes useless in 2 years. But the AI company needs 30 years to pay the money back to you. The AI company also needs to continue buying new GPUs and continue borrowing money from you. What else? Private equity funds love lending money to software companies the most because their income is stable, clients automatically renew their subscriptions every year, and profits are very high. But another problem appeared. AI emerged. I can now use one AI to achieve the effects that previously required 10 apps. Doesn't this mean that one AI can steal the business of 10 software companies? If these companies have no business, does it mean they can't repay their debts? So right now, as more and more companies are failing to repay their loans, a crisis identical to 2008 has emerged. Private equity funds say to them, "It's okay if you can't repay. I will continue to lend you money. As long as you don't go bankrupt, the debt I lent out won't go bad." So now a repayment method called PIK, or payment kind, has emerged, which is adding the interest to the outstanding debt. For example, you borrowed $1 million and owe $50,000 in interest, but you can't afford to pay it right now. You don't have to pay this $50,000 yet. You just add it to the principal. So now you owe 1.05 million. Next term, if you still can't pay, they take 5% interest from this 1.05 million debt. If you still can't pay, they continue to add the interest you owe to the principal. Isn't this just compound interest? And this is why so many investors have started withdrawing money from private equity funds, because they see that private equity funds took their money and lent it to these software companies that basically won't repay, and into GPUs that become worthless in 2 years. UBS says that the default rate of private credit has surged from 3% to 15%. During the worst of the 2008 subprime crisis, those bad debts were only around 15%. So the first cockroaches appeared. These private equity funds are now experiencing a bank run. The second and third cockroaches have also appeared. For example, a used car loan company in Texas went bankrupt. This company packaged high-risk subprime auto loans into wealth management products, gave them a AAA rating, and sold them to Wall Street. The exact same car loan was mortgaged to 3 different banks simultaneously. The UK's MFS has collapsed. This company also mortgaged the exact same asset to several private equity funds and borrowed multiple times. First, Brands also collapsed. Only after its bankruptcy was it known that it played with 20 times leverage. BlackRock also personally admitted that several $100 million they lent out cannot be recovered.
Ow.
So has the financial crisis already surfaced? The Federal Reserve, in a single day, secretly printed $15 billion. And this money wasn't even used to buy U.S. treasuries. So where exactly did this money go? Yet countless people are still unaware of these things. They only know that a war caused this global crash. So a person, in their entire lifetime, might only have 1 or 2 opportunities to make real money. If you miss this chance, it's gone. During the 2008 financial crisis, some people went bankrupt, while others bought the dip and got filthy rich. If you want to be the one buying the dip, you need to be prepared. That is exactly why you need the SFA Free Stock Investment Masterclass. Click the link in the description to join our public course and learn the top escaping signals before a plunge, completely free. Why are countless people losing money during this plunging process? Because those without stocks in hand just blindly buy the dip and end up buying halfway down the mountain. Those holding stocks either panic and cut their losses, selling at the absolute bottom, or they stubbornly hold on waiting to break even. The result is missing out on the money-making opportunities of both the plunge and the surge. You must learn the signals to lock in profits in advance, as well as the highly profitable opportunities when trends reverse. But do we really just judge the development of the situation based on news, financial reports, and current events? How the situation will develop only helps us predict a general direction. But we haven't time-traveled back from the future, nor do we have a crystal ball. We are not the game makers. We cannot control what changes will occur or exactly what time they will happen. Even if the general direction is right, you can still lose money. So we must not only learn to plan our layout alongside the charts, because only charts will reveal the clues of the capitalist layouts clearly. And more importantly, since even Warren Buffett is bound to lose money sometimes, what we need to establish is a loser's strategy. In 2026, Stewardship Finance Academy put this newly improved investment system into a free public course. Spots are very limited, so sign up at the link below as soon as possible. Alright, now that the story has reached this point, have you smelled that familiar scent yet? In 2008, banks lent money to people who could never repay. In 2026, private equity funds are lending money to software companies that are constantly being eliminated, or AI companies that might default at any time. In 2008, banks used short-term deposits to buy long-term mortgages. When depositors wanted to withdraw money, the bank had no money to give. In 2026, private equity funds use redeemable short-term capital to issue long-term loans. Now, when investors want to withdraw money, the funds have no money to give. They are all borrowing short to lend long. In 2008, they slapped AA ratings on garbage mortgages and packaged them to sell to the whole world. In 2026, even though these corporate loans have no ratings, they can still blindly bundle them and sell them to insurance companies and pension funds. It's all about packaging junk bonds as gold. It's all leverage stacked on leverage. The first to crash in 2008 wasn't Lehman. Lehman fell much later. The first to crash were those institutions pumping blood into mortgages. The first to crash in 2026 isn't OpenAI, nor is it NVIDIA. The first to crash are the current foundational institutions pumping blood into AI, like BlackRock and Blackstone. But there are differences too. This time might be an even greater crisis. Because the scale of the subprime market in 2008 was $1.3 trillion. Now the scale in 2026 is $3.5 trillion. Also, there are more retail investors now. In 2020, only 5.5% of private equity fund products were bought by retail investors. By 2024, it had already surged to 16.6%. Retail investors' money panics much easier than institutional money. At the slightest sign of trouble, it will trigger a much more terrifying bank run than now. And here comes the most crucial point. Did you know that in the 2008 drama, there was another character that nobody paid attention to? When the play ended and everyone had lost all their capital, it made a fortune. It was Goldman Sachs. Let's rewind to 2006. U.S. housing prices were still rising. Banks were desperately lending, and Wall Street was frantically buying AAA-rated junk bonds. Everyone was saying housing prices will rise forever. But internally, Goldman Sachs made a decision and started shorting the U.S. real estate market. How did they do it? They found a group of hedge fund clients and pitched something called a credit default swap. This allows investors to bet that a certain bond will default. Goldman Sachs said, "Do you guys want to bet? I will provide you with the tools." So, a batch of hedge funds followed Goldman Sachs and quietly began shorting those subprime mortgage bonds. At the same time, Goldman was continuing to sell these junk bonds to others. It was selling goods on one hand and shorting the very goods it sold on the other. Then in 2008, the subprime crisis blew up. Lehman collapsed, Merrill was sold, AIG was nationalized, and global markets wailed in grief. What about Goldman Sachs? It lost $1.7 billion on subprime loans. You might say, well, it lost money too. But what is $1.7 billion to a giant like Goldman Sachs? No one knows the answer even today as to how much money they made from shorting on the other side. In 2008, Goldman Sachs was not only the first to run, but also the first to lead the charge in shorting. So what about now in 2026? At the exact same time node, private equity funds start facing bank runs, AI companies start failing to repay money, and software companies start getting slaughtered by AI. And then, Goldman Sachs makes a move again. This time, the tool it is pitching is called a total return swap. The name is different, but the essence is the same. It's letting investors bet that a certain loan will drop. This time, the target of the shorting are the loans of those software companies being impacted by AI. In 2008, they shorted subprime while simultaneously continuing to sell subprime products. In 2026, while they are shorting software company loans, they are still issuing bonds for these software companies and still raising funds for these private equity funds. And at this moment, let's look at another person, Warren Buffett, in 2008, after Goldman Sachs shorted subprime. He swooped in and bought the dip in U.S. stocks, making the most money of his life. Now in 2026, he is once again holding massive amounts of cash, is selling stocks, reducing his holdings, and hoarding cash. What is he waiting for? Waiting for private equity funds to crash? Waiting for the AI bubble to burst? Or is it that he is waiting for Goldman Sachs to raise its butcher knife again, following right behind, picking up the bones left by those who were slaughtered? History never repeats itself, but it always rhymes. This time, who will be the one getting slaughtered? I just want you to know, when you think war is causing the crash, someone is quietly counting their money. When you think your money is still there, the doors might have been closed a long time ago. Nowadays, as soon as many people make a little money, they go buy a car to make it convenient to go out and play. This directly slows down the pace of you getting rich. The reason people are poor is not because they earn too little, but because they spend too much. The first pot of money you save is like a hen. Its purpose is to continuously lay eggs, letting the eggs turn into more hens to lay more eggs. But many people, once they get their first hen, can't wait to eat it. If you don't know how to use the money you earn to spawn more money, you will forever be on the path of searching for hens. The more times are like this, the more you cannot invest blindly. If you feel that investing is a skill you will have to learn sooner or later, then you absolutely must hurry. Sign up at the link in the video description box for the SFA Free Stock Investment Masterclass. I sincerely hope this content helps you achieve financial freedom soon. See you next time.